Hi, everyone. Uh, Welcome to the third in our series on financial risks, innovation, and inclusion in a post-COVID world. I'm Nirvikar Singh, co-director of the Center for Analytical Finance at UCSC, and I'll introduce our moderator, my colleague, Professor Bruno Sanso. He's professor of statistics at UCSC, a member of the Caffeine Steering Committee. He's an expert in Bayesian statistics and a fellow of the American Statistical Association. And I'll just stop there with all his qualifications and honors and hand over to him to introduce our speaker and to moderate the panel. Thank you all for coming.
Thank you, Nirvikar. Thank you all for coming. It's a pleasure to be here introducing Omar in this talk. I met Omar in the early 90s, and he was a brilliant student from Mexico, coming from ITAM, which is one of the elite institutions in Mexico City. He was doing a PhD in statistics at Duke University, and eventually he graduated doing a very interesting thesis with Mike West on latent structures for multivariate time series. And he went on to do a very successful career in finance with a number of institutions. Eventually, about 10 years ago, he decided he was fed up with the city, and I'm referring to New York City. He decided to come over to California, to Menlo Park, and now he's settled over there and working as senior vice president and chief investment officer of passive equity and multi-asset strategies for Schwab Investment Management. And well, it's a great pleasure to have him here. And well, he is going to be giving us his best knowledge of what is going on in the financial world and how these things are being affected by the COVID world that we live in right now. So I'll stop there, and all yours, Omar. Thank you for being here.
Well, thank you very much, Bruno, and thank you for the invitation. It is a pleasure for me to be here. It's an honor, Nirvikar and the team, to thought of me for giving a conversation this morning. And also, you know, I, as Bruno said, he just reminded me on how old I am, since it is, yes, I came to the United States to get the graduate degree in the early 90s, and it's been a long journey. But today, you know, we'll talk about some modeling, some stats, but mostly we'll talk about economics, and we'll talk about, you know, some of the things that we do here at Charles Schwab when we actually talk to our clients about, you know, what happens in this year, which is kind of one of the, you know, most interesting yet challenging years that we have ever lived in our lifetimes. And that's by itself just a big, you know, part of the process we're going to go through. Just in any framework, I think I need to share my screen. I will try, because I am, see if this works. I think this is the one. There you go. Hopefully that is in good shape and you can actually see it. Okay, so we'll put it in perspective. I was very curious, obviously, in the title of the seminars, because the seminar basically covers something that says, you know, economies in the post-COVID world. And honestly, I think it is something we all strive to be in, even though I could probably say for sure, and think all of you will agree, we're not yet in that post-COVID world. So everything that we'll talk about today is what we hope, you know, will come, you know, once we get to that post-COVID world. So the first thing that I will do is explain a little bit. And, you know, I always start, you know, most of my talks, especially now, and when we talk about clients and, you know, think about, you know, the complication in the world just by showing a picture like this. And I always, you know, some of you may have seen it. I always try to ask the question of, you know, would you see an old woman or would you see a young woman? You know, I used to have a third option, you know, would just say, do you see a monkey? You may not, you know, see, and it'll take 1 second to try to see if you can identify if you see the young woman or the old woman, and it doesn't say anything about your age or your, you know, anything related to what you're thinking. But just so that you can figure out how this works. Both of them are there. There is an old woman and there is a young woman that are part of this picture. Let me see if I can make the pointer work. There you go. So the young woman is having has a hat here. This is her nose and is facing backwards. The old woman, this is her nose. This is her mouth. This is her eyes, and she has a little bit like a hood, and she has like a coat over there. Again, I used to joke with people to say like, there was a monkey embedded in this picture, but there isn't. But I can tell you that when you do this in a live audience and you ask people to raise their hands, there will be people that will raise their hand even for whatever you think that there's in the picture. The point of this picture is not just to, get me more settled in the conversation, but at the same time, it's also to just reflect the fact that our brain and our eyes usually play trick on us. And I know in this world, and specifically for this audience, we're all talking about objective measures of the economy, objective measures of data, and we're fairly structured. But at the end of the day, it is our brain that immediately plays a big role in our decision making. So when you think about what this does, and what this does in many cases is the fact that when you see equity markets and when you see finance, those behaviors, if your brain can play you trick with your eyes, just like in the previous picture, when it comes down to seeing pictures like this of equity performance, when you see your balance of your brokerage accounts or your 401k, your retirement, and when you see the different changes, those could actually trigger very different behaviors in investors and in general. And that's, again, being human. We always talk about behavioral finance in the context of science. And in the context of science, there's two parts of the brain. The limbic system, which is the part that is inside there in yellow, that controls our emotions. This is the part that allows us to react. This is the part that allows us to get excited when a soccer game is going, or a basketball or a football game. This is the part that is so controlling of everything that we feel. And then there is the more developed part of the brain, which is in the light gray area over here. That is the more advanced part of the brain. That is the one that controls all the rationality, all the objectivity, everything that we like to do when we're doing a statistical modeling is all control for that gray part that is in there. This is all data driven, where we are trying to make rational decisions based on the tangible items that we can actually have. So what I like to talk about this, I think in the introduction part of what I like, I do have the background similar to Bruno on Bayesian statistics. This is the perfect representation of Bayesian statistics, because on one hand, you have the prior knowledge, which is all that yellow piece, which is all about intuition. It's all about what you feel before you start thinking else. Hard to measure, hard to put it into a statistical piece. And then you have the data that comes into the likelihood to that piece of the brain. So in a way, our brains are all wired, in a way that, it's consistent with everything that we do when we model the information. All right, just to say, this is exactly a perfect example of what it is. This is the emotional part of the brain. Is people are screaming at the TV. I'm sure all of you have done this when they get excited about sports. Some politicians also get incredibly excited about debates. On the other hand, you see the cognitive piece, which is you're looking at a lot of data, and then you're trying to be smart, and you're trying to come up with decisions. You're trying to create models to figure out what's going to come ahead. Now, why do I tell you all this, especially in a year like 2020, is because when you put all that together and how our brain operates, and then remember the picture that I showed you at the beginning with the two women, and you actually then get inundated, and I would kid you not, inundated with everything that comes on your phones, on the screens, on TV, everything else, that just creates an incredible amount of uncertainty and changes how those two parts of the brain are changing in there. Because when you see the headlines you get on these papers, immediately you start talking about, there's a crisis. Immediately you see these charts that basically show how everything is going down. Immediately you say that this is the worst situation we have seen since 2008. So that immediately gets panic, fear, and greed that are a big part of, how you explain, the behavior that we saw because of the pandemic. So what we do here, and again, this is very, very keen of everything that we provide for data is, we get a lot of data, and our job in many cases is trying to understand from that perspective, how are the market taking information? And as you know, in the market efficient theory, at the end, in the long run, markets are efficient and market takes care of themselves and they continue to grow based on Bill Sharpe's theory. But in the meantime, there is all this movement that happen, while we get to that long-term trend. And what happens in those cases is that you get a lot of changes that are based on different things that are part of our brain. So investors, as much as we are, and markets, as much as we are, they're not perfectly efficient. They basically move and they have different changes, depends on, what happens in any given day, in any given week, in any given month. And in this case, I just put here examples of what happens from the 4 years ago election all the way through what we have seen in the last, few months. This is a chart of the S&P 500 going back to just 4 years ago, and you can actually see how, depending on what happens over time, whether it's data on the economics, we can see changes on the way that we think about the investment opportunity, all the way through what we see today, which I'll talk in a second, which is COVID. Obviously generates significant amount of reactions, and again, this is going back to the brain, trying to understand what those pieces go. I do remember having a conversation like this 4 years ago when I said, well, we got to be ready, because for the next 4 years, at least, we're going to be related on a lot of this emotional and cognitive information based on tweets. So the tweets from the president, actually make a significant amount of impact on the way that the market behaves in any given time, whether it's, the US-China trade deal, whether it's their push for stimulus, whatever it is that comes out of Twitter, it usually has an impact, at least shorter term, into the market. So when you think about this and put it in perspective, so we got into, the coronavirus, and I'll probably put this into perspective. So as we all know, the coronavirus is not the first pandemic that we have lived. Now, it is the worst that we have lived, in our lifetimes, because prior to this one, we had obviously the Spanish flu back in the 18s. But the latest has been as significant levels of different types of pandemics that have affected, in their most recent time, from the SARS to the swine flu to even the small pieces of Zika and Ebola. And in all these cases, again, this is the chart of the S&P, the market has treated them as natural disasters. Now, what happens with natural disasters, just like what happens when you have a big hurricane, when you have a big earthquake, when you have, even a terrorist attack, is that for the most part, the natural disaster happens and the market and the economy gets recovered because there is a significant investment in just trying to get everything back. Well, in this particular case, and this is the reason of this conversation, is that, we are at the middle of that natural disaster. So you can actually think about, whether it's an earthquake or a hurricane. Well, the hurricane comes in, ends, and then the recovery period starts. Well, in our case today, we're still in the middle of the hurricane. The COVID, health crisis is not done. And therefore, it's still, the market trying to figure out how we're going to go from here. And not just the market, but in general, the economies in the world are trying to figure out how they're going to cope with this, going forward. So the first part of what we do, because it's hard to predict the future, is to understand, how the market behaved during this crisis. So I'll try to explain this quickly in the first two parts of this conversation. It will take me just 5 minutes. And then I'll go through the most important parts, which is, what comes next. We try to explain this in 3 phases. The first phase, which is right here, the collapse, emotional reaction, most of it, related to, uncertainties surrounding the health crisis. So we started with a health crisis, which is the coronavirus, moving to a very quick and amazing aggressive recovery that we have seen over the last 6 months, going through where we are today, which is, pretty much uncertainty. We don't know the market, the economy still don't know where things are actually going to go from here. So when you look at this, what happened in March of this year? All of a sudden, we saw in a very quick period of time, a significant change in market behavior. The market in one single day was down over 3,000 points. That's around 13%, which was a significant, set of losses for investors. That created the fastest bear market on history because it just from peak to trough after being in all-time highs, all of a sudden the market just, had more than 30%, losses. That continued with obviously a recession and a continuation of concerns about the virus. So what that does, it does create uncertainty. So volatility picks up. When you actually see what happened in March of this year is that the levels of risk associated with the market were incredibly high, even as high in some intradays, as what we have back in the Great Depression in the 1930s. It was definitely, at the same level of the crash of '87 and even worse than any time that we saw back in the crisis of 2008. Now, people ask me all the time, well, was this consistent with what we saw in 2008? And I'll touch on that in a minute, but I will just say this very clear. Today, the market and the crisis is started with a health crisis. It is a health crisis, or what we had in 2008 was started with a financial crisis. Big difference, big difference. Both of them led us to a recession and an economic crisis, but the source of the recession in 2008 was financially. The source of the recession in this time around is health oriented. And those, again, I will talk about that in a minute, are very big differences of what we see for the current economic situation. So as I said, big, change in the market, 34% losses, very, scary situation because nobody knew what was going to happen with the virus. Even worse than in some of the cases of the days that we had back in 2008, even though the losses, aggregated losses during 2008 were almost 60% and took roughly 4 years to recover. In the case of 2020, I think the level of uncertainty was so high that 30% was the fastest on record, mostly because people were really, really, really scared about what that could happen. And not only they were scared because of the losses, but they were also scared because they had no idea how that was gonna change their lives. Immediately people were worried about their own health situation, unrelated to anything that had to do with even the financial or economic crisis. And actually, this is what happened. And this is actually quite interesting. As you all know, we went to a lockdown back in March. Everybody started to stay home. And this is a chart that I love because, when you see in here is, March 9 compared to April. And this is the number of homemade consumption of different alcoholic beverages. So this starts with all kinds of whether it's beer, or whether it's mezcal, or whether it's wine, anything that you can come up with. After that March event, seems to be like everybody started to use what it was funny called quarantinis, as people started to just get more comfortable making these as a result, obviously, of the stress that came from the virus. So what happens after that big shock into the market? Well, big loss aversion. So this is again in the context of behavioral economics. The biases that usually play into it. The first one is everybody's flight to quality. Remember, I showed you that picture of the brain. That yellow part of the brain, the limbic system, immediately says you got to save yourself. So what happens is everybody went from the safety to asset. We had a huge amount of flight to quality to treasuries and the safest part of the market. So everybody migrated, and the resulting 10-year yield went all the way down to below 1%, which is something that, at the time, if you're, I still remember talking to investors early this year, we were talking about the potential for 2.5 to 3% 10-year yield over the next couple of years. Nobody even in their wildest dream ever thought that the 10-year yield was going to be below 1%, during that time period. Second one, recency bias. Recency bias is another one of these behavioral biases that are well studied in economics, that basically show that people don't see beyond, what is happening, next. In other words, they look at the most recent past and they extrapolate for the future. So what happens in those cases is if people see the market going down 28% in a week period, immediately think the world is coming to an end. And just like Chicken Little, immediately people think the sky is falling apart. So of course, what that does is just exacerbates the level of losses to the point that people obviously get insignificantly worried. And again, those are incredibly emotional reactions that people normally have. Confirmation bias is the more cognitive piece of the brain, where immediately people started to just go for toilet paper. Again, completely irrational. You don't understand. We still don't understand why you have to go and pile on toilet paper. Yes, it's understandable that hand sanitizer was not available, but toilet paper was, still. And it is interesting because Procter & Gamble just reported earnings just this week. And one of the things they said is they still have high demand for toilet paper. Again, big part of the only explanation is that confirmation bias that tends to says like, well, if everybody's buying toilet paper, we should go in and buy toilet paper, which again, just puts a lot of this, good for Procter & Gamble, good for other producers. But clearly, as you think of all the natural disasters, everybody braces for the worst. Again, you would think about food, you would think about water, toilet paper. I don't know. It's hopefully in the Q&A, somebody can actually give me a good explanation of what that is. All right. After that, go to the phase 2, which is, okay, the government. The government decided that this was a big crisis. The recession was around. There's labor market started to get softened. All right. The world was just collapsing all at once, all during the month of March. Immediately, money had to go in through this. So two things: monetary policy, fiscal policy. The Fed increased the quantitative easing, still is in that program. The ECB, the Bank of England, every single central bank around the world just incredibly opened their wallets and put everything they have. And I got to say, they acted so much faster than they did in 2008. They learned a lot from there. They didn't let this get out of the hand. I would probably say we'll be talking a very different situation now, hadn't they done that, back then. At the same time, amazing, fiscal packages that we saw across the world. What you see in the top chart over here is the amount of millions and millions of billions of dollars that we had across all the regions, from, the developed markets to emerging markets, to the US, to China, to everybody basically putting money to work to just try to get some stability to the economic crisis that we had. The US was particularly aggressive in the fiscal stimulus going into the particular pandemic. And when you combine those two things, when you combine the fact that the Fed is supporting the market from the monetary policy, putting the very lower bound on interest rates, and you combine with the fiscal policy, this is what happens. Immediately goes to the next bias, which is overconfidence. People think that nothing can go wrong, and therefore, when you actually see, the explosion of trading, right, after 20 days after, the biggest bear market on record, you saw a high record of trading as people are starting to just buy into the market, thinking that the market was never going to go down because the Fed and the governments will not let it happen. Well, guess what? They were right. They made the right choice because we have seen a huge recovery in the market since then. I put this chart in perspective, mostly because, again, this is the S&P 500 going back to the mid-90s. This is when I met Bruno, probably a little earlier than this. But you can actually see the cycles going there in two different, sets of bull markets here, from the crash in 2000 to the financial crisis of 2008. And then since then, the big bull market that we have seen for a decade. And then, the spike and the recovery that we saw. The big difference, I would say, well, this is still a cycle that we're going through, is down here, which is the interest rate cycle. You can actually see that back in the late 90s, we were at 6%, interest rates with the 10-year yields at 6.4. When you actually see what we saw in 2009 is that 2.9% in terms of interest rates. And when you actually see what we are now, it is below 1%. So it is quite significantly a big difference on what we saw. So when you actually compare, because people have asked this before, what is the difference between 2000, 2008 and now? Well, the big difference is, the levels of interest rates. The Fed in a room for maneuver and central banks maneuver is actually quite different than what we had before. So let's go to the next phase, which is, all right, so we know that we went through a bad period of time, very emotional reaction. We recovered. What's happening next? Well, I would call it this is unprecedented uncertainty. I actually saw this, can actually, tap into the Google database. And for the last, 6 months, the number of of times that people have used the word unprecedented has been unprecedented. I think that's probably the word that people like to use for describing 2020, is that unprecedented market conditions. And, all the economists are actually thinking about, what is going to happen with the economy and how we're going to recover. And everybody relates to just different shapes of the curve, starting from a V-shaped recovery, which means we're going to recover very quickly, and we're in that process. Got to say, we're 60%, on that V-shape, to the extent that we believe that's the case. Other people think that, well, because we are not done with the virus, we're probably going to be in more L-shape. And recently, I heard a discussion that talked about the K-shape, another letter, where basically saying, well, K, that means for certain people that are wealthy and the wealth effect, it will actually feel like a V shape, but for people that are losing their jobs, it will actually look like the other, leg of the K, which means it's going to look pretty bad, mostly like an L shape or worse. So it's still, a lot of uncertainty about the kind of recovery we have in the economy. We're still in that process of recovering. That gives us to, the key cyclical trends that we see in here. And I always try to think about this in the 5 points that I want to cover with you quickly. So there is 5 things that I consider to be the cyclical trends that we're living still today. We're in this cycle, as I said, we're not out of the recession. We have recovered, but we're still not out of the woodwork. We're 60% away from the lowest. Clearly, we have seen the economy recover faster and rebounded from its lowest point that we saw back then because of all the money that was thrown into the system. But we still have things that are key for us to get out of this that will determine whether we go into any of the letters that I put in the previous slide. The first one is the virus. That's the source of the recession. And again, the difference in here is we start with a health crisis, translated into economic crisis, is not, and I be very clear, is not a financial crisis. The financial institutions are still very solid and still maintain a significant amount of the stability that we see market-wise. 2008 was different. It started with a financial crisis that translated into economic crisis. So that's a big difference. But the health crisis is still the source. Again, natural disasters, we need to get out of the natural disaster in order for us to just have a good path forward. The next thing is consumer spending. Consumers will play a big role in the recovery. Unemployment claims at the labor market and credit market, as well as China, will be big parts of the trends that we have. So let's talk about each one of them quickly. The first one is this chart, which you have seen. You have seen it in every piece of news, and everybody talks about exactly how these plays out. Well, the number of cases, the number of trends is not helping. We have seen a significant amount of increase of cases. What you see in here is the United States in itself, all the way through the latest, which is just 2 weeks ago. And this is the rest of the world. What you see in here, you probably can not see it very well, but the US is this burgundy color. Latin America is this blue one. The rest of the world is here. China is the blue. And in all cases, we continue to see that the number of cases continues to increase. Obviously, there is consequences of this. You can actually see the what is called the second wave, because you can see the second wave is affecting, and here is the regions in the United States, the Midwest being the most affected thus far. We see that here in California, things are starting to get a little stable, after a rocky, end of the summer. Things continue to be a little better. I would actually say that the fires, in a very, evil way, help in maintaining a little bit of a stability to the number of cases for what we saw on the West Coast. But we can actually see that these trends are not helping. And when you look at Europe, that's actually even more concerning. In terms of mathematics and statistics, obviously, the way to model the virus trajectory is through the negative binomial distribution. We have seen shifts in the way that these probabilities change. What you see on here is just the binomial distribution, and it basically shows the bars, how many people, you can infect if you have the virus, is roughly, with these being sort of the average, roughly around 2.5 people. That's what you had before the second wave. We see that this line is moving, everywhere, especially as the second wave starts. Outside of the super spreaders, as they call them here, this is when people people go into weddings or the people go to other areas. This seems to be the trajectory of this. And what this is important for economics is that, depending on how this line moves, is the severity of the lockdowns. We have actually seen every single country thinking about going back to lockdowns. The United Kingdom just announced them just 2 weeks ago. Parts of Europe continue to have. And what you see in this scatter plot here is the severity of the lockdowns on this axis relative to the potential impact to GDP growth. And we can actually see here is there is different, the more severe are the lockdowns, the more impact you have on negative growth. The more loose you are, obviously you have less impacts on the economic outlook. And I will talk about China in a minute, because this dot over here is China, which is an outlier from the rest of the world. The consumer momentum is at risk. So we saw just this week a huge, surge in retail sales. So retail sales is good. The consumer is healthy. Looks like everything is moving along because the consumer continues to put, a lot of emphasis on the spending, and that's great because 60 to 65% of our GDP is depending on consumer spending. Where the consumers are spending, this is the credit card spending numbers, is mostly food, home, sporting goods. People are working out. People are doing, home, projects. I know we are doing some of our home projects, landscaping, changes in certain areas, and obviously trying to figure out, trying different types of foods. But obviously that seems to be very well done, even through, and is very stable. And again, the retail sales that we just saw, it is incredibly positive. With the exception that, when you actually look at that, where is the money and who is spending, it's kind of weird, because what you see in the chart over here on the left side is the green line is those consumers that are in the low income category based on the definitions, where you see the red line here is the ones in the high income. So what we have seen since March is that a surge in consumer habits in spending, mostly in the low income part of the market, at the same time that saving rates, just spiked, through the roof, in this recession, which again is kind of strange given, what this happens. And the explanation is the stimulus. The stimulus, created that amazing, piece of spending. What you actually see here is that, the amount of spending you have on credit card and debit card all the way through July, which was the $600 that people had on unemployment, program, part of the PPP program, expired. But obviously it's consistent with people, once they didn't get the $600, the amount of spending, went down. The other piece that is not as optimistic is the fact that, yes, the goods and the part of the manufacturing piece of manufacturing goods and spending in goods is actually recovered quite nicely. A lot of that is because of this spending, but the services sectors, which is a big part of our economy, is still not recovered. It's not even close. And again, if you look at the economic impact of this looks more like an L for the services sector. And without the services sector, it's going to be very, very hard for the economy to get back on track. The next point, so I talk about, consumer, I talk about the virus, it is the labor market. The labor market, it is obviously a big indicator of what we see so far. And obviously it's a big chunk of what it is. And we have seen a little bit of a stability on the unemployment claims that we see week after week. That seems to be the best statistic. The concerning part of this is that, where many people were on temporary layoffs, and those seems to be the ones making the stability, the permanent job losses continue to rise. And when you actually see where those losses are on those big changes in payrolls, a lot of that goes to the services. So when you can actually probably cannot read from your screens is that professional services, food services, retail, everything that has to do with restaurants or anything that has to do with lodging is still a pretty big, part of the unemployment. And when you actually see areas that are doing not so bad, tends to be in financial activities, tend to do about transportation, and obviously the spending in federal government that is continued to help in here. So credit market continues to be very strong. And as I said, we still have not seen an issue in terms of financial crisis, and the credit market is a key part of this. And therefore, maintaining a good sense of the credit market is good. Why? Because what you see on the chart of the left side is that, smaller business are feeling the pressure, and there's a number of bankruptcies and closures of smaller businesses that continues to be concerned. We have not seen that effect yet into the credit market. We see a little bit of a blip going in through this period where we see a little bit of the softening of the credit market, but even in the high yield space, it's still, pretty well supported. And a lot of that is because of the monetary stimulus and the support of the market. Let me just go through China, because that's another big part of what I think is important. So China is kind of an interesting piece. China was obviously the source of the health crisis at the beginning of where things started, and they have actually made quite a bit of progress economically as well, quite a bit of progress in terms of how they control the virus. And what you can actually see is that their last report of their GDP change is actually positive. What you see over here is their exports from China to Japan also continue to do, very well. What is actually the most interesting piece is actually what you see on this chart on the right, which is the exports to the United States. Despite everything that we have done to make it tough on China and make it difficult with tariffs, make it difficult with everything that has to do with our relationship with them, the amount of exports from China continue to increase. And a lot of that obviously puts us as China is the only economy that actually will have positive growth on their economy in 2020. And it's obviously a big source of the future economic growth for the world going into 2021. I know that people ask me about this. Presidential elections usually are good for the market. Doesn't matter who wins. We see this, whether it's red or blue, those tend to be the ones that tend to drive. But at the end, most of this, this year might be different because of the way we're voting. But certainly, in general, the choice of a president usually tends to be positive for the market. All right, the final piece of the conversation is about, all right, what do we think are the long-term secular trends that we think was going to happen after this? The first one is interest rates. It is very clear to me that we're going to be in a period of time where interest rates will be low for longer. The returns on asset classes will continue to be low. This chart represents the 10-year yield. The inflation expectations continue to rise. So the negative real yield that we have is something that we're going to have to live with for quite some time. That has implications. The implications is that when you actually think about this, it's called TINA, which is there's no alternative. These charts represent the percentage of stocks that have dividends that are dividend yield that have higher dividend yield than the 10-year yield. That's, beyond anything we have seen before. We have up to 75% of securities in the S&P that actually pay higher dividend yields than what you get on 10-year treasuries. So what that does is that it puts obviously more demand for risky assets, and there's more demand for equities as a result of people needing income and people going into inflation, issues, which is, part of what I think is another trend, which is we're going to see higher inflation going forward. I think one of the things that will come out of the coronavirus crisis is that the concept of globalization will be at risk. And I would probably say this mostly because between supply chains being disrupted, immigration, mobility, as well as in general, the ability for people to work from home will actually create that, price inflation that I think is going to be affecting us, for the future. And I think those trends may actually have a hard time changing. At the same time, because of all the fiscal stimulus that has gone into the market, we should expect that all governments, because this is the entire, world, will be in higher deficits, which obviously puts a big pressure on currencies, but we should expect that governance will be in a deficit situation for quite some time until we actually get a solution to the crisis. The environment, again, we're living in California, we're very conscious about this. It's something that, we're going to have to go. It is going to be a big part of the post-COVID world. It is already a big part of our emphasis. What you can actually see in this chart is performance of the S&P and relative to just the energy sector. And there's a huge difference. And when you actually look at the different parts of what drives, the potential investments down the road, it will actually be, a big part of taking in consideration social issues, environmental issues, governance issues that I think are a big part of the research that I think will go down the road. This is a part that concerns me a lot, and I know a lot of you will probably be asking the same question, which is, well, Omar, you're talking about this in the sense that we're not out of the woodworks. The economy seems to be plowing along. It is sort of slowing down. The momentum in the economy is getting there. There is some secular trends that we're going to have: low interest rates, potential higher inflation, negative real yields. It doesn't look that pretty, yet the market continues to go up. And the market continues to go to all-time highs. And if you close your eyes and you look at the NASDAQ performance for this year, it's close to 30%. It's just mind-boggling to anybody. And when you actually look at this chart, which basically shows the S&P 500 on the top relative to the S&P 500 correlations of advance and declines, it seems to be that there's a big disconnect of what happens within the S&P 500 in the market relative to the level of the S&P 500. And a lot of that is because of the other secular trend, which is the digital economy. When you see this is performance just through June, you can extrapolate a little bit more, but the NASDAQ has dominated, the performance of equities. And when you look at the FANG stocks, this is, Facebook, Amazon, Netflix, Google, that the performance of the FANGs relative to any other sectors, it is quite remarkable, which again shows about, I receive a lot of the questions related to, well, is this just another bubble like the 2000? Is this going to be something that at some point is going to break? And I would probably say that, this is the reason why this might not be just a bubble. When you see the growth of that digital economy, it has actually started in 2005 all the way through now, and actually now gone into, a significant amount of portion of the economy. When you actually see the little bubble chart over here, the size of these bubbles represent the big companies, whether it's Facebook, Google, Microsoft, Amazon. These companies are very profitable and continue to do very well with or without the coronavirus. In fact, the coronavirus has just created even more opportunities for them to continue to grow. If you actually just think about the fact that we're having this discussion, whether it's telecommunications, whether it's changes in the way that people operate business-wise, as well as education, this is something that benefits a lot of the companies that are right in this area. Just this morning, there was a big announcement about the fact that, there's many people that are just not disconnecting their cable services because everything is streaming. So a lot of these changes will eventually be part of what we'll see down the road. Which gets me to the last secular trend, which is, China, and which is, the dollar. We have seen a huge, rise in the dollar because the U.S. has been, the driver of stability over time. I can see that will potentially fade in the next few years, especially as we come out of this coronavirus, because, as I said earlier, the only economy that has been an outlier so far has been China. And, with their size and with their ability to cope with the coronavirus and with the relationships that they have developed within Europe and with everything else, that seems to be something that may change the leadership in terms of the international versus the domestic, which shows a little bit in here. The orange line is the United States versus IFA on the blue line, and obviously, you can see that going through this area even before the coronavirus, we have seen those trends going there. Now, I think the biggest challenge in here is obviously going to be related to what this could mean for trade, what this could be for immigration, and obviously those policies will be key in just the part of this. So to summarize and to open it for questions, we have seen obviously a big change into the markets over the course of this year. In just a short period of time, markets went through an emotional stage, moving to a recovery stage, into a period of time now where people are trying to find its footing. Where we see the current situations dealing to the consumer behavior, China being a big player, the credit market being extremely stable because it's not a financial crisis. Obviously, the labor market will continue to play a role as we go into the second wave of the virus, and then finally, the handling of the coronavirus will be key for us to get out of this. Going forward, and the secular trends of what we can actually see is, of course, interest rates are going to be low. The search for income is going to be a big driver of what we think the trends will be for investing as well economically. Demographics and immigration will play a big role, especially in the post-COVID world. As well as, we will see, changes in the leadership economically in the world in terms of economies that can get out of the virus in a different way, which obviously will play a big role of this piece. And the digital economy will be a big part of us down the road, and therefore the way that companies adjust to the digital economy, whether it's working from home policies, whether it's less business travel, whether it's more video conferencing. Those will obviously be things that will benefit and will change the scope of the economic landscape, as well as the economic of investing within markets. So I paused there, and I know there was a lot of information and I haven't left a lot for questions, but I'll turn it back to Bruno for any questions that may come from the audience.
Thank you, Omar. That was very nice, brilliant. Yeah, we don't have too much time, but there are a number of questions out there that will be very nice if you could at least comment on them. I mean, we do have to wrap this up at the hour. So what I'm going to do is I'm going to make a quick summary of what is being asked. There's like 6 or 7 questions that have been asked there. So one of the things that people were asking about is the impact of elections and the possible stimulus in the near future. Another question that was asked is there any way that the US can play a leadership role, and which role would that be in the recovery? Another question, a little bit in a different topic, is what about the internal movement of citizens within the US, like the migration that we're seeing out of the big urban centers and into the more suburban and even rural areas? Another question that was asked is what type of industry will come back to the US from abroad, if any? And then I do think that you kind of commented about this, but there was a question about the timing, scope, and the shape of the recovery as it differs from the market and the economy. So how we are seeing this disconnect between the market and the economy. Apart from that, I had my own personal curiosity, although, in the 10 minutes that you have left, you probably will not be able to answer all these things. But, you're a quantitative person. You talked a lot about things that are very psychological, like anxiety and an uncertainty and presidential tweets. How do you model that? I mean, how do you put that into your quantitative analysis? So there you go. That's at least some of the questions that have been asked.
Great questions. Let me go through the macro perspective first, and I'll answer the modeling second. So starting with the question on the elections and the stimulus, and that's a big part. There's no question in my mind that without the stimulus, we are not going to be able to get past these recession, and we have the risk that potentially get into getting back to the more issues. Why? Because the range of monetary solutions that we have from central banks is limited. We already have negative interest rates in the majority of the world, and the Fed has very limited room to monetary policy. They still can open their balance sheet and they continue to grow their balance sheet, that they will be doing whatever they can to support it. But in order to stimulate the economy, even the central bank heads will agree that that the need for fiscal stimulus is there. Why is that important? It is because the consumer, without having that checks into the hands of people that don't have a job, it is going to be very hard for people to continue to spend at the levels that they have, which is critical for areas that will continue to have issues, because I don't anticipate having the restaurants or the movie theaters or even just traveling on planes to be the same as it was earlier in the year. There will be significant reductions and therefore less need for for labor that requires, a shift in the way that people, and in that shift, people need to have certain ways to meet. So fiscal stimulus is going to be critical, and the result of the election will, in my mind, will probably be just a matter of timing. Depending on which party wins, it will actually be faster or it will actually be delayed. And I think it's sort of a component, but I could actually say that there is a very high probability that by January we're going to be able to get a good sense of stimulus. I doubt that we'll have something before the election, but obviously, and you can see this is part of what I was saying about the market being incredibly emotional. Every time that there is good possibility of a stimulus package, the market goes up. Every time that there's disconnect between the two parties, the market goes down. So it's obviously a big part of the same pieces. Going back to the second question about the mobility and the changes and the suburbs and the cities. There is obviously a lot of discussions about, what the digital economy does, because, you can now have conference calls. You can actually now hire anywhere, anybody. And I would probably say that at the beginning, there will be quite a bit of a change. But I do think that over time, there's not going to be a 1 and 0 situation. Why? Because a lot of corporations, a lot of, universities, a lot of schools, still, pay a significant amount of attention to the entire, area of, the community and the culture that you create by having people in the same room. And therefore, it's not the same experience to actually being here than for me to be in an audience and talking to you. Even just psychologically, just my body movements are not the same in 2 dimensions that it is in real life. And therefore, it is hard for me to think that, while there's going to be adjustments and there's going to be more flexibility, it is not going to be that all of a sudden everybody's going to move out of the cities and everybody's going to be work from home forever. In fact, I actually see already the exhaustion that exists in people and the anxiety that comes because people are tired of Zooms, people are tired of WebEx, people are starting to having to need for getting closer to others, which I think is going to be, again, it's not going to be going back to February of this year, but at the same time, there will be quite a bit, which I think the biggest component in there is going to be the fact that, yes, there will be probably a boom in second, homes. I think we already seen people buying, second homes in Hawaii and Tahoe and other places. We have also seen a boom in the used market, or used cars, because people don't want to take mass transportations. People actually want to use a car to just be feeling safe. I actually think that those trends, similar to what happened in a natural disaster back, say, for example, September 11, you see a shock, a big adjustment, and eventually those things, while some of them may stay, some of these will just, disappear. So I can see that, probably over the next few years, we're going to see a change, but I think in the long run, things will probably just go back to a good balance. Now, going to your question on how do you model this? Well, it is not an easy piece. I think the big part of what we do here is we do have a lot of data. We do use a lot of models, but you have to include the concept of learning and the uncertainty that comes from the fact that at any given point, you have to understand what are going to be the drivers of the market and the investments, say, for a time horizon. So if you come, and try to see, all right, what do I need to do to model, the next 15 years? That's an easier decision, believe it or not, than what it is, what do you need to actually do to model the next 2 months? Mostly because the volatility associated with the emotional component and the inefficiencies in the market is very hard to predict. And even the most high frequency models that we use, they're very hard to calibrate, especially in areas where we have not had data before. This is the part where Bayesian statistics plays a big role, mostly because by creating that level of ongoing learning, allows you to narrow down the pieces. And if you actually see what we saw back in March of this year, the amount of dispersion that we had in all our estimates was huge. In other words, pretty much any estimates of anything that had a parametric view was basically off. And we basically didn't even pay attention. At that time, we basically moved towards long-term trends to say, all right, we see this big spike. We know these things are going to happen. What is going to happen in the next 10 years, which we know the impact of those shocks is less. And therefore, the distribution of returns and the distribution of volatilities is actually more stable than if you actually try to do it more on a high frequency basis.
Boy, we still have a couple of minutes. There are a couple of new questions that have appeared in the Q&A. One is some mention of the real estate sector trends. What are your thoughts about that? Then there is a question about your chart with emotional versus cognitive distinctions on market movement. What basis do you distinguish? Then there is a question, well, my interpretation of the question is, what happens with the cost of the stimulus and well, basically that's my interpretation of that question. Then there is a second question, what about long-term impacts on unemployment, in particular structural unemployment? So we have 2 or 3 minutes and then we'll have to wrap it up.
I'll try to be brief. So let's start with the stimulus because that's this piece. So yes, the stimulus will go into the deficit. That's the big chunk. Now there's two consequences of that. Number one, by creating higher deficits and at the same time, reducing the level of globalization, having, less mobility and less immigration, immediately you have higher inflation. So that in itself obviously will play a role going into the next few years. And the other piece, which is, we still in the United States have the dollar, which is sort of the currency that is used around the world, is the base currency, which means that, is not going to represent an issue as long as that's still the case. And this is the part where I'm discussing about China leadership in this area. The minute that the dollar loses its power in the world, the less ability we have to be able to counter inflation and deficits down the road. Therefore, it is important to maintain that sort of leadership globally, especially, as you see, how the dollar behaves, because, the size of the deficit, which is related to how the stimulus will work, it is going to be a big chunk of how this will play out down the road. I'm not worried about us, but I'm worried about our kids, because that's where we're going to actually see the impact of this stimulus and these deficits, for their cost over there. In terms of the permanent losses and the permanent jobs, I would probably say that the big impact that it is going back to consumption. I think so far we have seen that the majority of the permanent losses is still in the lower income part of the market, but they're starting to go up. In other words, as long as the recession and the labor market stays stronger into the mid-level income and higher income, we'll continue to see stability there. The minute that we actually see a change in those, even if the numbers, because obviously the unemployment rate, it is just one number, but you actually drill down, it is real about just income growth as well as purchase power. It is the part that actually matters. So as long as those losses of jobs stay within an area that does not affect consumption, I think we're going to be in probably good shape. And then the last piece, I know we have to wrap up on what do we do to actually differentiate between emotional and cognitive. It is a data exercise. We have models that allows us to understand, for example, the put-call ratio. It's an information we have, sentiment indicators that allow us to know whether or not the market is moving on fundamentals or is moving on just trends, and that allows to determine whether or not there is a potential one of those. So we have a database on all the biases that are emotional, a database that are all the biases that are cognitive, and we try to match those characteristics with the data that comes from the market to try to guess, what is the sort of the reasons why the markets are moving in certain way.
Great. Well, thank you, Omar. It's been great to have you here. It would have been greater to have you in a real room, but this format actually allows us to reach out to a very wide audience, and that is one of the nice things about it. Thank you very much to Professor Nirvikar Singh, because he invited me and he invited me to be part of this, and I really enjoyed it. I also have to thank you, our sponsors, CAFIN, UC Investments, the Institute of Social Transformation, and the Division of Social Sciences. Thank you very much to everybody who attended. And well, have a very nice weekend. And please do remember to vote. Bye.
Thank you, everybody. Thank you for having me.